Hi, and welcome back to another slightly less lockdown and arguably a little bit more sunny version of the Fit Finance sessions. The full three musketeers are here today. So myself, Henry Ellison, and Tom Senegals. And today we're going to talk about something a little bit different, an article which we've all come across on the BBC, and that is entitled 5 Animals to Spot in a Post-COVID Financial Jungle. So a bit of a different one. But I think it goes without saying that throughout this period of life, clearly, everyone's perspectives has become a little bit more sharpened or honed on their own finances and sort of the financial world in itself. And a lot of people have heard of bull markets, bear markets, that kind of thing. So there are sort of animal references chucked all around the place, but I thought it was something worthy of mention anyway. There's 5 of them, and so we're just going to run through them, go through how they sort of relate to the common man, and a couple of things to look out for. So who wants to jump right on in there with number 1?
Well, I think the first one is a lemming, and as maybe we wouldn't describe ourselves as lemmings, but I think I think the lemming investors are the GameStop and other shares that we've talked about a little bit on the podcast before, and people just following the herd. So it's great when things are going up, but doesn't mean they'll always can continue to do so. And I think we've seen a lot of that behavior, whether it's in crypto or certain stocks or gold or toilet paper hoarding. There's a lot of herd mentality going on at the moment, and I think trying to see through some of that rhetoric you see in the news is often a good thing to do as well.
I think it's very easy though, with the media as it is being all prevalent around us, that actually creates this sort of lemming mentality, doesn't it? I mean, certainly with GameStop, that's what we saw. It gets onto Wall Street bets, and everyone who's following that piles into GameStop and BlackBerry and whichever other companies are involved in it too. I don't think it's here to go. I think it's here to stay. But you're absolutely right. You've got to be careful, because you don't want to just invest in GameStop. You want to have it. We said it before. Well-diversified portfolio will beat any single stock over the longer term normally.
Yeah, absolutely. Just to jump in there, by the way, a lemming, I didn't know this, but a lemming apparently is a small rodent that lives in the Arctic, and used to be associated, or thought to be associated with taking part in mass suicides by jumping off cliffs into the unknown. Hence the reference with those sorts of investors just jumping in blindly and off other people's backs, etc.
Thank you, David Attenborough.
Well, I've never heard of it. I don't know whether you guys have it. So number 2. So that's number 1. Number 2, grey rhinos. Now I think these are related to black swans, black swan events. But who wants to take this one?
That's 2 animals there, which is great. I would no doubt David in a short while will give us a full genetic rundown of the two beasts. The black swan is an unexpected event, as well as a dark feathered avian. The point being that these things come along, we're not expecting them, and one then takes a look back when you've been past this and goes, yeah, well, there was no way we could ever expected that. Examples perhaps are the great financial crisis back in 2008, and indeed the coronavirus catastrophe that's happened over the course of the last year. But what a grey rhino would say is, well, actually, some of these events could have been seen. They were great, big, gargantuan beasts there on our horizon, and if only we'd looked in the right direction, we would have seen them before they came hurtling towards us, knocking our economies left, right, and centre. So was the coronavirus? Is the coronavirus? Could it have been spotted? And how would we position ourselves if we had known it was coming? But more pertinently, is there something else that's there in view, but we just haven't quite spotted it yet? Haven't asked the right questions. The obvious answer to that is no, because otherwise we'd have spotted it and done something about it. But it'd be interesting. I think if any of our listeners have thought of a grey rhino event that they can see coming towards us, and indeed how they might dodge it. They're pretty nasty beasts, rhinos.
I think as well, sometimes clients will say, well, surely looking back, it was obvious to be in X or Y. And I think you can't predict, even if you know what those events are, you can't always predict what the market's reaction will be to those events as well. I think plenty of times everyone's been worried about certain events, whether that's Brexit or the Euro debt crisis. You don't actually always know how the market's going to interpret some of these big events, and that's why we just have to have a foot in each camp for different scenarios. I think if I was going to say there's a grey multicolored rhino or whatever it is, then I think major things like climate change or I know the sort of structural trends, maybe working from home and how work is more dynamic going forward. And I was looking at something yesterday where towns in Italy are selling houses for €1 because they're sort of abandoned ghost villages in the countryside. And actually now, with a more work from home digital sort of universe, then there's no reason why, I know, young people who can't get on the housing ladder could move out to rural locations, work online and create new communities. And so I think whilst grey rhinos might be things to look out for in terms of risks, there's also sometimes big opportunities that come about by big sort of life-changing events too.
Yeah, absolutely. Well, apparently Bill Gates seems to have thought that COVID-19 wasn't a black swan and was in fact a grey rhino. So apparently, but question number one would be:
it's always easy to say that in hindsight, though, isn't it?
Yeah. Exactly. Right, number three is an individual who likes to make a quick hot deal for a bit of a quick buck before galloping off. Can any of you guess what animal I'm talking about? I'm talking about a stag investor. A stag investor, yes. Fire away, Tom, seeing as you wanted to jump in on that one.
Hopefully we'll see Squidge on a new episode. Squidge being Tim's pet rabbit. The stag investors, I think it's more referring to IPOs. I think a lot of these tech companies have been floating recently, and actually I think M&A activity in the SPACs and lots of companies are either launching or going private or whatever it is. And I think overall, I think if you bought into every company that was launched into the market and bought every share offering and bought the same amount, you do probably quite well over time. I think the problem is picking the winners and losers. The averages work out fine, but I think you've only got to look at Deliveroo that listed last week and had a massive fall on the debut, and even hot stocks like Snowflake, I think launched last year in the States, had a very good initial run from, I think, circa $200 up to $300 in share price, but then has subsequently fallen back off. So I think, again, IPOs can be great, and it can be the latest next Tesla, next Amazon, next anything, but not all of them are winners at the same time. So law of averages does you well. Being diversified does you well, but not every hot new investment is going to go to the moon.
I quite agree, and actually I was reading an article recently about that in light of what's happened with Deliveroo, because there have been some great launches that have happened through the course of the year, and Airbnb's done pretty well out of their stock sale. That actually you do see some great returns sometimes with these companies. It wasn't that long ago that Facebook and Google and all that lot IPO'd, in fact. But also, and then you often find that it's the ones that aren't so heavily marketed, because there might not be common names that we see all the time, and they're the ones that really do very well. So it's all well and good knowing that, you know, you had your curry delivered by delivery last night, and therefore I'll go and put some money into their stock sale. But actually it'll be a whole load of companies that you've never heard of, and you've got to do your research and analysis to work out if they are likely to do well as when they IPO. But history seems to show that those littler ones tend to do a little bit better actually than some of the big ones. And another one, of course, is Royal Mail, which I've been talking to a few clients about recently, and it's not been the best performing stock that people may have heard of. But of course, it's one that everybody did hear of, and it was a big IPO when it launched, whatever it was, 6-7 years ago.
Yeah, I think it's that lemming mentality, I guess. When you're investing, you've got to think about the long-term vision of that company. Just because there's a lot of hype over a few months, and even if it does really well initially, because of that hype, they're kind of self-fulfilling prophecies. If you're investing, you should be investing for the long term, not just speculating on this month to the next month on whatever the latest hot IPO is. And actually, think about it, are the management teams incentivized over the long term? If they've been running the business to get it ready for a big initial share sale and they get their big payday, how much incentive is then for them to grow over the next 10 years? So yeah, if you're doing individual stocks and looking at IPOs, then you best do your due diligence as well.
Yeah, definitely. I think the only thing that I'll add on to that is, of course, with IPO shares and companies, of course, there's no reference to previous price, clearly, because that's obviously the birth of the price of that particular company. So the market will tend to sort of flail around for a bit whilst it sort of finds its feet, and investors see sort of where's fair value for that particular stock, rather than, I mean, clearly there's financial models and all sorts of different calculations done to determine the start price. But of course, the main thing for the company doing the IPO is they want full subscription, they want full uptake really of their shares, was be lost in the wind. So typically you may see that they'll undervalue it to sort of guarantee that the take up. But yeah,
I think if you're not willing to sit there and go through the previous few years' company accounts and sit there and read them, then you shouldn't be participating in the first place. So if you don't want to spend the time to do that, then don't even put your pieces on the chessboard.
Yeah, exactly. Just admit you're either a stag or a lemming at that point. Okay, so 4 out of 5. This one is the coolest in my opinion. I think it's pretty cool. And apologies if there's any German listeners I'm about to butcher the language of. But this one is a hamster cough, which you probably know is a hamster. And the reason why this one's chucked in the mix is for the German words referencing hamstern, which is hoarding, and kaufen, meaning purchase. So clearly sort of the whole hoarding mentality. I mean, as we know, in the COVID pandemic, we saw toilet rolls become gold bullion. But yeah, I mean, what do you guys think about that one?
I mean, it's good. I think all three of us would encourage our clients to save, and to save regularly, and in doing so, build a pot of money for the future. I think I suppose that certainly the pandemic that we've just been through, that would have been a huge benefit for some people by saving and putting money aside, because one stuff might have happened personally, they might have lost a job or what have you, and having a nest egg is definitely a great thing to have achieved. But also, if they continued to save, then they would have done so, potentially they'd have put money aside at the bottom of the market, and they'd have seen some really fantastic returns generated by the portfolio over the course of last year. I think that the risk of being too much like a hamster is taking too much caution. And certainly when you think of a hamster, you think of a shy little creature who scurries away from you, or when you're not stroking them, or they're running around in a wheel. I suppose the other two visions of a hamster, that's neither here nor there. But the point is being, if you can be too cautious and you're just saving and saving and saving, but not actually doing anything with your savings. And I think, as we're all aware at the moment, savings rates in a bank account currently are pretty much zero. And if you're doing that, and not then investing your money. You need to keep a little bit set aside in case the car breaks down or the roof falls off your house. But really then over and above that, you should be trying to get it in the markets, because that's where you'll see your real growth. And that's really where you'll see the real protection to your finances and your money coming from over the medium to longer term.
You've got to, there is risk in sitting in cash, isn't there? I think it's often seen as a riskless asset, but it's not. And I know economists predict 11 of the last two recessions. If you're always worried about the next thing around the corner, then you miss out on the growth in the meantime. Yes, you can always wait for the most optimal time, but I would say of those people hoarding, how many were confident to put their money in the market on March the 25th or something in 2020? You've just got to be able to go with the ups and downs. Yes, be sensible. Yes, don't take excessive risks, and sometimes take risk off the table. I think that's a lot of what we talk about with clients. You don't always have to be taking maximum risk, but you need to be taking some. You need to be enterprising with your money. Otherwise, the risk is it'll lose itself all on its own.
Yeah, it's a bit of a weird paradox, isn't it, really? Because, well, almost, because, I mean, whilst it's not always the case, but at the moment, as we know, cash, as you said, Henry, interest rates are so poor, and cash is, large parts of cash being eroded by inflationary effects. So that's a guaranteed outcome. Whereas, ironically, people aren't wanting to invest their cash in the market because of the risk, which obviously risk can go both one way or the other. You could do well, but you could also lose money. But you're saying you want to sit in a guaranteed position to lose money rather than put it on the table to make some money, potentially, obviously, and taking on some risk in doing so. But as long as you're invested in a well-diversified part and you're doing things sensibly, then you're not going to def it up too much. That's quite an interesting paradox, and something that I've mentioned to clients in the past.
It would, I think it would be interesting if we always talk to our clients about real terms in terms of when we're giving performance. So it'll be CPI, the measure of inflation, plus X%. I think if you had accounts in your bank account saying you're making minus money, so the figures were in minus money, I think a lot of people would be a bit more proactive in their approach if they started seeing it going down in real terms.
Yeah, definitely. I've done that for clients as well, to say, yeah, but this is how much, I mean, sort of a little bit of finger in the wind, but on this maths, this is how much you're losing each year. And that will happen, whether you like it or not, type of thing. And that seems to change their perspective somewhat. Okay, cool. So last but not least, we have the wolf warrior diplomacy. So clearly the idea of wolf. Now this one I'm not too keen on this one, to be honest. It's a little bit of a long shot. And particularly as we're trying to relate this podcast back to personal finances, I'm not really sure how the example that the BBC have given is something that the layman can avoid. Yeah, I mean, here, broadly speaking, the wolf warrior label is something which they've used in this example of being sort of a countries or governments having a bit of a bullish or more aggressive approach to diplomacy. So China being the example really here that the BBC have used. Now, for us to say in the podcast, hey, guys, be careful of China out there. It's not really a helpful thing to be saying, but I think mainly in terms of how it relates back into the investment world, clearly I think it's trying to say, look, just be careful of the types of broader institutions that you're putting your money within. Not everywhere operates on the same sort of basis and set of implicit rules that the Western world does. I think that's what this article was trying to get at anyhow. I don't know if you guys had any other bits and pieces to add on to that, but as I say, I'm less keen on this one really.
No, not really. I think that's right. The French have been pretty aggressive recently too, haven't they, with their but yeah, I mean, I think that's, yeah, it's nations or managers being aggressive with their defense of their own methodologies in looking after either their own businesses or their own investment strategies. I've seen a particular harm in that. One needs to be confident in the decisions that you're making often, and you would expect certainly our government to robustly defend our businesses too, provided the overall is being looked after at the same time as well.
Yeah, I think well, you saw that pre-pandemic in sort of the 2018 Trump and China trade talks, and you just see more volatility in the market because it's not consistent. It's more political. I mean, you've got the whole political thing going on with vaccines and who's stockpiling and who's. I think you're just going to see more of that in the news. I think. Yeah, so it's definitely something to be aware of. I think there's just going to be more volatility, but equally, I think to sort of summarise, I think don't be a lemming. Don't get your news from, or don't get your financial news from articles based on 5 different animals, because we have so many people speaking to us saying, "I've read this in the paper, or I saw this on the news last night." We're investing for the long term. If you're taking your financial advice from a journalist, and whether you're a hamster or a lemming, then I think you need to reassess and speak to a professional personally.
Absolutely fantastic caveat.
We are here to help you.
Brilliant. Cool, guys. Well, thanks very much for listening, and we'll see you in the next one.